I'm James Abdelmalek with Keller Williams Palos Verdes and Keller Williams Luxury International. I'm a California realtor, and as always, I prepared more informative videos that explain different topics in real estate and give you real estate market updates. Remember to subscribe to my YouTube channel and like my Facebook business page, James Abdelmalek Realtor. In today's video, we are continuing our new series called Real Estate Decisions. Today, we are doing real estate decision number 3. In my prior 2 videos, I discussed 2 important topics. In episode 1, do you sell your home now or wait? In episode 2, do you buy your home now or wait? Both of those decisions require understanding of the factors affecting the real estate market. Today, I will discuss one key factor affecting the real estate market: the economy. In our 3rd episode today, real estate decision number 3, I will be discussing to potential home buyers who are thinking of buying in the future or now, and current homeowners who are potential sellers who are thinking of selling their home now or probably in a later time. But the problem with whether you're a buyer or a seller, do you sell now or wait, or do you buy now or wait? As I discussed in my first 2 episodes, these require some analysis. Now I'm focusing my analysis on the economy. Today, I will teach you how the economy affects the real estate market. The economy is one of the 4 driving factors driving the real estate market. If the economy is doing well, then the real estate market is doing well. If the real estate market is doing well, buyers are able to qualify for bigger loans and more loans. If buyers qualify for more loans, number of buyers increase in the market. If number of buyers increase in the market, demand for homes increase. If demand for homes increase, prices of homes increase, and the market value of home ownership increases. More buyers become homeowners, and homeowners will have their home values appreciate with the passing of time in a good economy. So all this depends on the condition of the economy, or what will happen to the economy in the coming time period. So now, how do we know the condition of the economy, or what's going to happen in the economy? How do we anticipate the effects on the real estate market? As a general rule, a good economy means higher wages, more capital gains and dividends from the stock market, more job opportunities with higher salaries, increase in financial assets due to the rise in stock markets, and 401k values. So still, how do we know and understand? We need to look at the economy from 3 perspectives: the economic indicators, the economic direction, and the stage in the economic cycle. Let's take them one by one. The first one, the first perspective, economic indicators. The economic indicators measure the health of the current economy. So we need tools to measure the health of the economy. There are many tools or economic indicators that measure the health of the economy, but I'm going to give you the top 4 used by economists to determine how healthy the economy is. First tool, GDP, or gross domestic product. This is the market value of all the finished goods and services that are provided inside the country within a certain time periods. The higher the GDP, the better it is for our economy. So if we're in a good GDP level, better than last year, then the economy is doing good. Second tool, employment. Employment is measured by the unemployment rates of the economy. Of course, the lower the unemployment rates, the better it is, because that means more people are employed, more people are getting salaries and wages, and more people are able to qualify for loans because they have a job. So of course, the lower the unemployment rates, the better the economy is. Third tool, independence of oil production and price of crude oil. The more we produce oil domestically and not rely on importing oil from outside countries, the better for the country and the better for the economy. The higher oil prices can drive job creation for people. So whenever you hear that the country is independent of oil production, this is good for the economy. Fourth tool, CPI, Consumer Price Index. This measures the average change in prices of the country's products compared to last year. We expect the CPI to increase at a moderate to low level. That would be good for the economy. If it increases drastically, that is not good because that would lead to inflation. Now, let's go to the second perspective, economic direction. We want to know what direction the economy is heading. Is it going to be flourishing or is it deteriorating? We measure this by two possible tools. The GDP change compared to last year. Second tool, financial markets. Let's go to the first tool. The first tool, change in GDP. If the change in GDP is positive, if the GDP is increasing, that's good for the economy. That means the economy is moving in the right direction. The GDP is increasing, more jobs, more wages, more people able to qualify for loans. Second tool, financial markets. There are many aspects of the financial markets, but we're just going to focus on two of them. First one, the stock market. We measure the general performance of the stock market through a market index or different market indexes. A market index is a hypothetical portfolio of investments that represents a segment of the financial market. The most popular ones you need to keep your eye on is NASDAQ, S&P 500, and Dow Jones Industrial Average. All of them measure a snapshot on a daily basis of the performance of the stock market. In order to get a big picture of what's happening in the economy, basically, we need to look at trends. We cannot look on a daily basis just one day, the economy is good or bad. We got to see where the trend is going, where the graph is flowing. Second tool, the bond market. As interest rates in US Treasury notes rise, it means banks can raise the interest rates on new mortgages. Home buyers will have to pay more each month for the same loan. It gives them less to spend on the price of home. Usually, when interest rates rise, housing prices eventually fall. Third perspective, stage in the economic cycle. There are 4 stages of the economic cycle, which was also referred to as business cycle, that every economy in anywhere in the world go through. These 4 stages are expansion, peak, contraction, and trough. Through these various changes of the economic cycle or phases in the economic cycle, there are different interest rates and different states of the economy. Let me illustrate in the following graph how the economic cycle works and how important it is to know what stage in the economic cycle we are in at the present time. The expansion phase is when all the economic indicators I discussed show signs of economic strength. Strong GDP, low unemployment rate, independence of oil production, and financial markets are booming. And this phase nears its end when the economy overheats and the GDP growth rate is greater than 3%. Inflation rate is greater than 2%. Usually, interest rates rise to slow down the economy, which is the part we'd be interested in. That's the time when interest rates are expected to rise. So when we get loans to buy homes, interest rates will be higher, purchasing power will be lower. That's the phase when we near the end of expansion, that's when the interest rates rise. The peak is the second phase, in the month when the expansion transitions into the contraction phase. The third phase is contraction. It starts at the peak and ends at the trough. Economic growth weakens. GDP growth falls below 2%. When it turns negative, that is what economists call a recession. In a recession, you'll hear about large and massive amounts of layoffs happening from companies and employers. It will be all over the news. The unemployment rate begins to rise. Interest rates in this kind of scenario tend to decrease. Stocks enter a bear market as investors sell off their securities. The trough is the fourth phase. That's the month when the economy transitions from a contraction phase to the expansion phase. It is when the economy hits rock bottom. If you are wondering what phase we are currently in, we are recently starting the expansion phase. We are in a recovery mode right now. The GDP is rising, unemployment is declining, and financial markets are on the rise. Through those three economic perspectives, we can determine the state of the economy which influence the future direction of the real estate market. And I mean the direction of the home prices and interest rates in the market. Understand those and you will understand what will happen in the market. My next video is going to be about a very hot topic. My next video is going to be about real estate and politics. Subscribe to my YouTube channel to be notified about the video when it comes out, and like my Facebook business page, James Abdelmalek Realtor. If you need any further details or more explanation about today's topic, don't hesitate to text me about any question you may have. If you want to sell your home or buy a new home in California, anywhere in California, call and text me anytime, and it will be my pleasure to work with you. If you want to buy or sell in any other states in the United States, text me the city and state you're in, and I will recommend the best realtor for you to work with. See you in my next video. God bless.